All right, welcome to this explainer. Today, we are diving headfirst into the world's largest lender. It's a critical Chinese financial stock that honestly, almost nobody here in the US is even talking about right now. We're looking closely at the Industrial and Commercial Bank of China, or ICBC for short. In a market that's just completely obsessed with the promises of artificial intelligence and flashy futuristic tech revolutions, this company is doing something vastly different.
I mean, think about the sheer contrast we're dealing with. While everyone is out there endlessly chasing sky-high valuation tech and AI stocks that pay out basically pennies, like ASML with its roughly 0.5% yield, or Tencent hovering right around 1%, this traditional banking behemoth offers a wildly different path. ICBC is sitting on a massive 5.11% dividend yield. For income-focused investors, that is a completely different value proposition. But a high yield like that always begs the million-dollar question: is this a genuine value opportunity, or are we just staring down a classic value trap?
So let's kick things off with Section 1, Inside the Banking Goliath, the world's largest lender.
To really figure out if this is a true value play or a trap, we have to understand what the Industrial and Commercial Bank of China actually does with its unbelievable scale. We need to strip away the ticker symbol and examine the real machinery here. Founded in Beijing back in 1984, ICBC uses its monumental deposit base and government relationships to run massive, bread-and-butter lending operations. We're talking deep entrenchment in corporate and personal banking, treasury markets, international banking, infrastructure, and consumer finance. So no flashy AI chatbots writing your emails here, just the traditional, highly lucrative business of loans, deposits, and fees. That sheer scale gives them an enormous advantage. But as we all know, being the biggest guy in the room doesn't automatically immunize you from the usual banking risks.
Let's see how that scale translates into their recent earnings story. Looking at the first quarter of 2026, they pulled in absolutely massive absolute numbers. We are talking about roughly 222 billion RMB in revenue and around 88 billion RMB in net profit. On the surface, that is a fantastic start to the year. But if you look closely, you can clearly see a lag. Revenue grew by a very solid 8.4% year-over-year. Yet profit only managed a 3.9% increase. So profits are growing, sure, but they are lagging way behind the top line. Why exactly is that happening?
That brings us to Section 2, the margin squeeze problem. This is the core threat to Chinese banks right now.
That slower profit growth leads us straight into the biggest macroeconomic headache facing the entire Chinese banking sector. It's basically the invisible force deciding if that massive revenue actually makes its way to the bottom line for us investors. The absolute central metric for our analysis today is net interest margin, or NIM. In simple terms, this just measures how much a bank makes from the money it lends out compared to what it pays to fund itself through deposits and borrowing. For ICBC, in that first quarter of 2026, NIM came in right around 1.29%. Now, management did note that this metric recently stabilized, which is absolutely huge. After years of downward pressure, just hitting a plateau is a really positive signal for a bank of this magnitude.
But we have to keep an eagle eye on this metric because Chinese banks operate in a really unique environment. When the government pushes for cheaper financing to stimulate the broader economy, it kicks off this massive domino effect. Basically, interest rates drop, which means loan yields drop. That instantly squeezes the bank's margins, causing profitability pressure to spike. This right here is exactly why you can't just run a stock screen, see a 5% dividend, and blindly hit buy. You've got to understand the macro chain reaction that could threaten the very earnings keeping that payout alive.
Which segues perfectly into Section 3, the dividend safety check, evaluating the yield's cushion. So if profits are feeling the heat from the macro environment, the obvious question for income investors is that juicy 5% dividend actually safe? Can ICBC keep earning and stay strong while handing out all that cash? Well, the number that perfectly illustrates their safety net is 32.6%. That is ICBC's surprisingly conservative dividend payout ratio, meaning they're only handing out roughly a third of their earnings to shareholders. The rest, they're keeping it to fortify the balance sheet and fund future loans. In the banking world, having a payout ratio in the low 30s gives you a really comfortable buffer against any unexpected earnings shocks.
Let's break down the actual income profile here. ICBC is offering an annual dividend of approximately 4.5 cents per share, which gets us to that super attractive 5.11% yield, and they pay it out semi-annually. But the really compelling part is their track record. They've maintained a consistent rising dividend trajectory from 2022 straight through to 2026, with current dividend growth sitting at roughly 4.31%. The takeaway, for income seekers, this looks fantastic. But come on, we know better. A high yield is never 100% risk-free. We have to figure out what could actually break this positive trend.
And that brings us to the big one, credit risk. The main threat to that dividend safety cushion comes from China's ongoing struggles in the property market. It's a textbook chain reaction. You have weak property sector activity, which puts serious pressure on developers, construction firms, and even everyday households. That triggers a dangerous sequence where borrower defaults start rising. And when defaults go up, the bank is forced to increase its loan loss provisions, which is essentially just them setting aside a bunch of cash to cover the bad debt. That directly eats into net income, and boom, the safety level of your dividend drops. Now, ICBC's sheer size definitely helps it absorb these shocks better than the smaller players, but that same size means they have massive exposure to this exact cycle.
So before making any moves, you absolutely have to weigh these 5 big risks. We've got slowing economic growth, property sector loan losses, and that NIM compression we talked about. Risk 4 is state-linked government policy shifts, meaning government priorities can heavily dictate where capital goes. But I really want to emphasize risk 5 here, OTC liquidity. ICBC trades over-the-counter in the US under the ticker IDCBF. Listen, you cannot just assume the last price you see on your screen is immediately executable. You have got to carefully verify the bid-ask spreads and trading volume. A terrible bid-ask spread, that gap between what buyers will pay and sellers will accept, can literally wipe out your entire 5% dividend yield on your very first trade. So always use limit orders and check the liquidity.
Fortunately, ICBC isn't just sitting around waiting for the sky to fall. They are actively reinforcing their balance sheet. They recently raised a combined 80 billion RMB in total capital. That's split between 60 billion in Tier 2 bonds and 20 billion in additional Tier 1 issuance. In plain English, they are stockpiling financial shock absorbers. This is exactly what you want to see a major bank doing when the environment gets tough. They survive by building these massive, thick capital buffers to absorb unexpected credit losses, ensuring they can keep their lending power robust without having to slash those shareholder returns.
Let's wrap it all up with Section 4, the final investor verdict, navigating the upcoming catalyst.
This crazy balancing act between massive capital strength on one side and systemic macro risks on the other brings us to our final verdict. Here is your strategic scorecard for navigating this stock moving forward. You're looking at a buy if we continue to see NIM stabilize, net profit growing, and bad loans remaining firmly under control. If you are already in, you maintain that hold as long as profits are stable, the dividend remains sustainable, and capital is strong. A little temporary price volatility is not a reason to panic sell a solid dividend stock. However, you really need to consider a sell or reducing your position if you see margins falling sharply for several periods, bad loans suddenly accelerating, or capital weakening materially. You have to let the fundamental banking metrics make the hard decisions for you.
And the good news is you won't have to wait very long to evaluate those exact conditions. The ultimate immediate catalyst is already circled on the calendar, August 28, 2026. That is when ICBC releases its interim results. Mark that date. It's the moment of truth where we get to look under the hood and see exactly how their capital stockpiling and China's broader economic stimulus are actually playing out on the balance sheet.
When that date rolls around, the critical question isn't going to be about how fast their revenue is growing, and it's certainly not about AI hype. It is entirely about whether Chinese loan demand, credit quality, and bank margins are actually showing real fundamental stabilization. If those numbers look healthy, ICBC suddenly becomes an incredibly compelling value and income candidate. But if things deteriorate sharply, well, that 5% yield might not be nearly enough to compensate for the risk you're taking on.
Which brings us to a perfect summary. As we wrap up this explainer, I really want you to leave the tech hype at the door and remember this absolute golden rule for evaluating traditional banking giants. Don't just chase the yield. A high yield is literally only as good as the earnings supporting it. Fundamentally, follow the balance sheet. Watch the margins, watch the bad loans, and let the hard data guide your income strategy. But, it does leave us with one massive question to chew on. If a traditional, quote-unquote, boring bank like ICBC can offer this kind of yield while actively fortifying its armor, are we all just looking in the wrong places for the next big market opportunity? Thanks so much for joining me for this explainer. Keep focusing on those fundamentals, and I'll catch you next time.